Let's turn to our friend Jack Ablin to talk more about the markets as we head to the end of the year. Of course, he's founding partner and chief investment officer at Cresset Capital. Jack, good to see you again. Thank you for joining us tonight.
Nice to see you, Bill.
I mean, what a stellar December this has been for the markets, capping off what has been a pretty strong year again. What do you make of all this right now?
Yeah, I mean, it's a backdrop of lower interest rates, essentially. What we realized was that interest rates were a key driver of not only the economy, but certainly the stock market, given the level of debt that has really permeated the corporate balance sheets. Fed learned their lesson very quickly last year, reverse course, 3 rate cuts, and here we are, 30% move.
But we still haven't had one of those proverbial 20% pullbacks that everybody feels is necessary to clean out some of the dead wood in the market before it can reset and go higher again. We just keep going higher and higher.
That's it. I mean, you have, with the low interest rates and a friendly environment, you have companies, like Sears that probably should have been out of business 5 or 6 years ago at least, still, with more than 400 stores. So, I think there is some catharsis in a washout. We haven't seen it yet. My sense is it'll be precipitated by higher interest rates. I'm not sure when that will occur, but given how leveraged we are to debt, so to speak, any higher interest rates will push things lower. I don't see that around the corner, but if we get some inflation, if we get stronger growth than we expect, that could be a risk to the stock market.
Once again, technology was a big leader for the markets this year, and again, concentrated in some of those big FANG stocks and a few others as well. Is that where you see growth for next year, or where do you see opportunity in 2020?
Sure. I see, I don't see a repeat of the 30% growth. Keep in mind that, the earnings backdrop was only up about 3% this year. So clearly it was all PE expansion, valuation extension. Next year, analysts are expecting 6% growth in earnings. If we get no valuation expansion, then we should get around a mid-single-digit return for next year, all things being equal. Remember, an election year is generally a good one. Policymakers don't want the wheels to fall off the apple cart going into re-election, so they're going to try to stay pretty close to the center lane in overseeing markets. But given where what we've been, I don't expect anything in the double-digit range for 2020.
U.S. versus international. We've talked about the slow growth overseas, but that, there are signs that maybe that's bottoming out right now. Is that where you look for opportunity as well?
I think so. Seema was just talking about emerging markets, and yes, there are risks. But I will say, if you take a step back at these demonstrations, sure, near term, that is an economic negative if things aren't getting done. But if you look at what all of these protesters want, generally, more equal income distribution, that's pro-growth, because a dollar going to the lower income is going to be spent. A dollar taken away from the highest income will likely come out of savings. So that ultimately will be pro-growth. Right. We have a valuation spread between foreign and U.S. that's as wide as it's been in more than a decade. So I do think we're going to see the foreign markets catch up as long as economic growth continues, and there's no reason. I don't see a recession on the immediate horizon.
Jack Ablin with Cresset Capital. Happy holidays, my friend.
Yeah, thank you, Bill.
See you later.